This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street for Monday, October 27th, 2014. Recorded just after the market close in New York. We had a quiet day today for a change. I'm going to go over the news item that I think was the most important and generally ignored piece of news today, along with a couple of items from the Fed's balance sheet and the Fed's weekly report on the banking system that I noticed this week and I think are going to be very important to the outlook for both stocks and bonds in the U.S. So let's take a look at those things. While it didn't get much coverage or discussion in the mainstream media today, I thought the most important story was the release of the ECB's data on its covered bond purchases last week. And as it turns out, the total purchase amount was 1.7 billion euros, which really is a drop in the bucket in relation to the total size of the ECB's balance sheet, which currently is around 2 trillion euros. This chart should give you some idea of just how infinitesimal the 1.7 billion euro purchase of covered bonds was last week. This little downtick here was the prior week, ended October 16th, and that little downtick was 12 billion euros. So the 1.7 billion euros that are added to the line this week for the covered bond purchases wouldn't even register on this chart. By the same token, just going back a few months, the balance sheet has shrunk since June from about 2.2 trillion down to 2 trillion. So the balance sheet has shrunken by about 200 billion euros since the institution of the negative deposit rate back in June. In order to offset that, it means that these new purchase programs that are being instituted now by the ECB would need to add 40 or 50 billion per month in assets in order to offset the downward pressure that's being exerted by the negative deposit rate. Recall that when banks hold funds at the ECB as a result of them being issued loans by the ECB, they're now being forced to pay 10 basis points in interest on those deposit holdings. So in order to get rid of that additional cost, that 10 basis point cost, the only way to do that is to pay down the loans. Somebody in the system has to pay down the loans and thereby reduce the offsetting deposit. So that pressure is going to be there. That downward pressure on the size of the ECB's balance sheet will continue for as long as this negative deposit rate is in effect. The new purchase programs, the asset-backed securities and covered bond purchases, at best, under a best case scenario, they might cause the balance sheet to level out. And maybe if they're doing 1.7 or 2 billion per week in asset purchases, well, sure, that's going to add about $10 billion a month to somebody's account, but that's really an insignificant amount. It's not enough to significantly impact the markets, whether in the Eurozone or the U.S. certainly. So for now, we have to look at these new programs by the ECB as I originally predicted they would be, non-events and basically con jobs. Now, at the same time, the speculation started today that as a result of the weak rate of purchases here, that the ECB would begin to consider outright purchases of corporate bonds or government bonds. Now, government bonds are probably not going to be in the mix because it would be a violation of the ECB's rules, and Germany is against that. As far as corporate bonds, I just don't know. But the program being voluntary would tend to reduce its effectiveness in terms of forcing liquidity into the system, as the Fed does or has done with its QE purchases. There's no obligation among the banks participating in the ECB operations. There's no obligation for them to buy the securities. I thought it would be interesting to see how the mainstream media, in particular the Wall Street Journal, Bloomberg, and Reuters, treated the story. The headline from Reuters was ECB covered bond buying plan starts with a whimper. And I think that's a pretty accurate characterization. Bloomberg had a headline bearing ECB says 1.7 billion euros of covered bonds bought last week. They didn't spin that one way or the other. The Wall Street Journal had an article, a straight news article, which was really buried. Nobody would have seen it if they hadn't been looking at it. But they also had an opinion piece that included discussion of the purchase. And the headline on that was, "No curtain calls for markets for ECB." And what the Journal said was the European Central Bank can't seem to catch a break at the moment. So they kind of downplayed this purchase too, and I think correctly so. The Journal went on to say, at the same time, the ECB's efforts to increase its balance sheet and loosen monetary policy have so far left the markets feeling less than impressed. And again, I think that's well characterized. The ECB announced on Monday the first results of its latest securities purchase program, saying it had acquired 1.7 billion euros of so-called covered bonds. And then they go on to say, but in the context of a 2 trillion euro balance sheet, the amount bought is a drop in the ocean. And the purchases followed a lukewarm response in September to the central bank's first round of cheap 4-year loans to banks. So the implication is that the program is failing. However, it goes on to say a little bit further down, the amount of covered bonds bought also underplays ECB activity. So they have the on the one hand, on the other hand routine going. And it says that it covers only purchases that settled last week. So only those made in the first 3 days of the week. Purchases of more than 2 billion a week would be relatively aggressive. 2 billion a week would be 8 billion a month. Again, that's just not enough to offset the downward pressure on the ECB's balance sheet that we've seen from the negative deposit rate that forces some holders of deposits at the ECB to pay off the outstanding loans. Whatever the ECB is doing right now is, as we predicted previously, is not working. It's not going to be enough to offset the downward pressure on the balance sheet. At most, it might cause the balance sheet to level out. But at any rate, 8 billion a month, 10 billion a month in net purchases is not enough to move the needle on the markets, either in Europe and certainly not in the U.S. Now, another story that everybody is watching this week is, of course, the FOMC meeting this week and the announcement that's going to come out on Wednesday. And virtually everyone has concluded that the Fed is going to end its asset purchases. If you follow the Wall Street Examiner Professional Edition Fed report, or if you've listened to me in these programs here at Radio Free Wall Street, then you know that the purchases are not going to end completely. The Fed will continue to purchase 15 to 20 billion per month of MBS paper, and that's because approximately that amount of its holdings get paid off every month as individual mortgage holders refinance their mortgages. The mortgages that are in the MBS are paid down, and therefore the MBS are paid down, and some of those are held by the Fed. The Fed is getting cash back on those. Its balance sheet holdings are shrinking by 15 or 20 billion a month in any given month. So they're going to continue those purchases at that rate. Now, the Fed's balance sheet will stay level, but the primary dealers will continue to get cashed out at 10 or 15 billion a month. Add to that another 10 or 15 billion from the ECB under these various programs, and maybe additional new programs that the ECB may institute. And now you're talking about 30 to 35 billion a month. And we still have the Bank of Japan, who's in there pitching the bull at about the equivalent of 70 billion or so a month, US dollar equivalent. So there, when you total the three central banks together, going forward, we're still looking at injections in the worldwide liquidity pool of approximately 100 billion a month. Now that's a lot less than the 200 or 250 or even 300 billion we saw at times in 2011 or 2012, that when the market was really running. But 100 billion is not zero. And so the expectation that bears have, that because the Fed is supposedly ending its asset purchases, and there's going to be a big sell-off in stocks as a result, I think that idea is misplaced. I think that the cash that will be pumped into the markets by these three central banks will put somewhat of a floor under prices. Now, there's going to be less liquidity around, and that process began when the Fed began to taper its asset purchases, and the more it reduced those purchases, the greater the amount of volatility we've seen in the market. So I do think that the reduced liquidity flows will result in some increase in volatility such as we've seen. Now, it looks like we're seeing an enormous amount of volatility in the market, but it's all relative, really. We went through a period where there was so much liquidity that the market simply somnambulated. It sleepwalked higher on very low volatility because there was so much liquidity in the market. Now, with a little bit less, we've had this, what looks like an enormous increase in volatility. Relatively speaking, it has been. But in terms of history, it's really just a return to normal or maybe slightly above normal levels of volatility. So I think that going forward, we have to be careful with the increased volatility. When significant support levels are broken, we can't jump to the conclusion that we're starting a bear market. It may just be a manifestation of increased volatility. In other words, the magnitude of the smaller waves that go up and down as the stock market trades in short-term cycles, the magnitude of those cycles is going to increase. And if the normal magnitude is greater, then we're going to see these false breakdowns and potentially even a false breakout on the upside from time to time. I do think that we're going to be pretty much stuck in a trading range. I think at the outside we might see 2040 on the S&P, or we might stop at no more than the recent highs. I want to take a look at a couple of the charts that were in the macro liquidity update that I just posted to give you an idea of why there may be some limits on how high this market can go and why I don't think we're going to see another major up leg. But at the same token, with all this liquidity that's still going to be pumped into the market every month, I don't think we're going to see a major decline yet. One of the charts I want to take a look at is the chart of the Fed's custodial holdings of Treasury and agency securities for foreign central banks. And something important has happened here in the last couple of weeks. This purple line here is the 4-week net of the foreign central bank holdings, the change in foreign central bank holdings of treasuries and agencies on deposit in the Fed's custodial accounts. And as you can see, over the last few weeks, there's been a tremendous drop, a very sharp drop in this number. It's down around 60 billion now on the sell side. That means the foreign central banks have gotten rid of 60 billion in their holdings of treasuries and agencies, and almost all of that's been in treasuries, by the way. And that is the second largest decline since the big Russian dump-off that occurred last spring when the political situation or the geopolitical situation was heating up, and the threat of sanctions apparently resulted in the Russians pulling a lot of their holdings out of the Fed. So in the meantime, there was some readjustment to the upside and there was some buying, but the totals have never exceeded, the total amounts held have never exceeded where they were towards the end of 2013. They had another peak here, maybe that was in August, but still below this peak late last year. And suddenly over the past month you see this decline in the total holdings, so that the 4-week net has dropped to 60 billion, getting rid of on the downside. Now, that could mean that in the short run we're going to start seeing a return to the normal buying pattern of the foreign central banks, where they show up at the mid-month and end-of-month Treasury auctions when the Treasury is issuing new notes and bonds, and the foreign central banks usually take down a significant percentage of that. That helps to levitate the Treasury market, and it helps to keep the U.S. markets in general highly liquefied. But that hasn't been the case here in the last 4 weeks. And as a result, the foreign central banks have not shown up to take down a significant portion of the net new Treasury supply. Now, in the short run, a couple of weeks ago, that was not a problem. But since the 15th of October, we've seen Treasury yields back up again. You may not have noticed, but they've backed up pretty sharply from the extreme low that they hit when they had that buying climax on October 15th. Since then, this foreign central bank selling has kicked in, and yields have risen. I think that if this represents a change in the need of some of these countries to possibly repatriate their dollar holdings because they have higher cash needs at home, then this could signal a significant change in the trend of the Treasury market going forward, and it would also result in reduced liquidity overall for the U.S. market. So this is something to keep an eye on in the weeks ahead, and I'll post this chart every week in the Wall Street Examiner Professional Edition so we can watch this trend. Another data point that the Fed releases each week is the aggregate commercial bank balance sheet in the United States. That comes out every Friday evening, and it's got about a 10-day lag. So this data here is through, I believe, October 15th, whereas the H41 data that shows the Fed's foreign central bank holdings is through last week, through the 22nd. But what I wanted to show you here is that as bank holdings of treasuries and agencies have increased, this line at the top, the green line here, is the inverted 10-year treasury yield. So think of this as the direction of the price of U.S. treasuries. The yield scale is, as you can see, is inverted on the right-hand side over here. So this is the direction of prices. And we had a bottom, a nice double bottom back here in 2013. And since then, prices have been trending gradually higher and yields have been trending lower. Now, I've drawn these ellipses on the chart to show you a similarity between what happened last week and what happened back in 2012. Last week, there was a sharp decline in bank holdings of treasuries. They actually got rid of about $6 billion of their total holdings of treasuries and agencies. That was enough to break this uptrend that has been in effect since approximately July of 2013. That bottom preceded the bottom in bond prices, or the top in yields, back here in July and again in November, December of 2013. Throughout that period, the trend of bank purchases of treasuries has pretty much been upward until last week, or until the week ended October 15th. Now, something similar happened back here in September of 2012, and that was the beginning of the decline in the bond market. If you recall, back in the spring and summer, the 10-year yield had gotten down to around 140, 150 on this scale. And then prices began falling, and they continued to fall for a year, and that was associated with, in particular, from December of 2013 through the summer of 2013, with some bank selling. So the uptrend in bank buying from 2011 through 2012 was associated with rising prices of treasury bonds. And then when that trend broke, that was essentially the top of the bond market. That's where prices topped out and yields bottomed out. Prices began to fall and yields began to rise from that point. So do we have the same situation here? We have a very sharp break in this trend. We've had a sort of a mini bull market in bonds going on for the past year, since November or December of 2013 until now. This could be a similar situation. It's certainly something that should get our attention, and we need to keep an eye on this trend here of bank buying and see if the technicals on the 10-year Treasury show a rollover in prices and the beginnings of an uptick in yield. We'll keep an eye on those factors. I post the updated chart of the bank holdings of Treasuries and agencies on a weekly basis in the Wall Street Examiner Professional Edition Fed Report. So that will do it for this week. Again, I want to stress that at the FOMC announcement on Wednesday, everyone's expecting that the Fed is going to end its asset purchases. And they are almost certainly going to end their outright purchases, but they're not going to end their replacement purchases. And that's a key distinction that I think most market observers don't get. The primary dealers will continue to get cashed out, 15 to 20 billion a month. They will continue to get cash from the ECB to a very limited extent, but from the Bank of Japan to a very significant extent. And as long as those processes continue, then the market is going to get some support from time to time. So we'll stay tuned for that FOMC announcement, see what kind of changes they make in the wording. That's kind of irrelevant. Watch what they do, not what they say. Now, next week, the next program that I'll be posting will be on Tuesday instead of Monday. Got some personal things to attend to on Monday. But we'll get together again next Tuesday. That's November 4th, Election Day. Until then, trade sane, have a great week, and I'll see you next week.